The basic concept of a value investing obviously is many, many decades old. But today, I think it is as relevant as when it was first laid out by Benjamin Graham at Columbia 6, 7 decades ago. There's essentially just three basic ideas. The first one is that stock is not a piece of a paper that you trade, but is a representative fractional ownership of a company. And therefore, valuing the stock ought to really have a basic variance of valuing the company as a whole. And then secondly, that evaluating any financial asset that you have to really predict the future, the discounted cash flow of the future cash earnings. And the future is inherently difficult to predict. And therefore, you really want to leave yourself a margin of safety so that you could be wrong or you could be right. But because the future is a distribution of opportunity, I mean, with statistic possibilities, say you bet on something that at 90% of the chances you could be right, but then a 10% chance occurred, and so all of a sudden it become 100%. So you want to leave enough of margin of safety. In other words, you want to buy at a low enough of a price, even if all the adverse events occurred against you in the future, you will still be in the game. It doesn't mean you won't lose money, but it just means that you will not lose so much that you'll be out of the game. Because investing is really a long game. It can play over the life of anybody's career. And so you want to be really in the game somehow over the long haul. And the third concept is Mr. Market, to figure out a frame of mind to think that when the market is against you, you can really look at it as a neurotic Mr. Market that's prone for emotional and irrational behaviors. So those are the three basic concepts. At the heart of it is obviously it is this bargain idea that you want to really get what you pay for. Now, obviously that's what everybody wanted. And if everybody wanted the same thing, you would think that all of the professional investors would be value investors. And that's just a further thing from the truth. In fact, value investing, as it's properly practiced, constitutes a tiny small minority of all the investment professionals. Majority of the people hold different views. And let me just articulate for them the alternative views about investing. Number one, that yes, stock legally represent a fractional claims, a fractional ownership, but is first and foremost a piece of paper you can trade all the time. And therefore, it follows that successful investing lies in the successful guessing of the stock movement based on whatever informed theories or practices that you can find. And thirdly, that the market is to be respected, indeed to be feared, because they really, through the market, you can actually find a value, and through the market, you can actually buy and sell. So this, here you go, a different view, and it sounds even more persuasive than the first views that I laid out as a value investor. In fact, I would say majority of the people really follow the latter rather than the former. So as a young student trying to get into the business, which way do you follow? I would suggest that before you do that, you would go to some fundamental studies as to the result of various different approach and philosophies. Unfortunately, there has been numerous studies have done because we kept a pretty good track record over the last 100 years at least. And all the studies have given an unmistaken conclusion that the true value investors, as it properly practiced, have consistently outperformed the market, whereas just about all other strategies either match the market or severely underperformed the market over a long period of time. Now you can dispute the result of it, but I think the evidence is pretty persuasive